Hello, welcome everyone. I'm Jerry. I'll be leading our webinar today on the influence of the central bank. We'll be talking about a couple main topics in this webinar. We'll be talking about the role of the central bank, interest rate decisions, the impact on government bonds and expectations, as well as the influence of credit ratings. And as usual with our webinars, we encourage everyone to participate. Whether you have a question, please feel free to raise your hand. Or you can also type it into our Q&A chat. We do have that available. Darren is able to help people. And if you are comfortable, feel free to throw on your video and you can ask a question live in person via your microphone. So first, to start off talking about the role of the central bank. For many of you, I'm sure you've heard of what the central banks are. Their primary role can serve one of two purposes. This can be hotly debated sometimes. But their main idea is to provide their country currency with price stability, which is mainly in the form of controlling inflation. There's also a lot of people-led theory that believe that countries should be regulating their unemployment rate as well. And this can also be done effectively by certain actions of the central bank. But the main focus will be on that price stability and inflation. There are a couple ways that a central bank can influence inflation rates with its interest rate, its primary tool. It can do so by increasing or decreasing interest rates. By increasing an interest rate, it becomes more expensive to lend money in the country, whether it's a business to a business or a business to a consumer. All those prices are going to go up if the central bank increases the interest rates, and that will lower the inflation rates. This is something that's been seen across the globe recently. Inflation rates have gone up, and central banks reacted by raising their interest rates in order to hopefully curb and tame that inflation as it went up. Of course, the opposite can happen. There have been countries with examples that have gone through deflationary spirals, but those are fewer and far between, and it's a trickier situation for countries to get out of. I will mention that one part that's great about OpenBB and our terminal is that you can run scripts and routines that can automate a lot of data outputs for you. There's an excellent routine that we have put together for this set of analysis. It's already logged in if you are logged into the hub, and in your terminal, you can simply type in the command you see in the bottom left of this presentation, exe -- and then file the influence of the central bank. It will take a couple minutes to populate and run the script. What you'll get is a huge data set of everything that we basically have for you right at your fingertips. You can look. And here's a little preview of it here. You can get ECB rates, Fed projections, CPI numbers. This is all of the raw data that's going to be coming out of the OpenBB terminal. Of course, it's easier to graph it and explore that data easier in the terminal. We know that many people do like to have their data at their fingertips in Excel or exporting to another statistical package, and this is a good way to do so en masse, so you don't have to run an output file multiple times in a row with just a different data point selected. So now let's look at interest rate decisions. So primarily for this section, we're going to be using the fixed income menu. And I'll show that live in a second. You can see that we have a lot of different options throughout this fixed income menu. And this is one of our many main menus in the OpenBB terminal. So here you can see my terminal logged in here. And I can simply, let's start with typing in the question mark. If you're in your terminal and you forget what something might be, we go to the main section here. And this will be all of our options. So if you're just exploring, you may not know what to look at. We have all of our main menus here. Fixed income, this is where we'll be at first. We have stocks and cryptocurrencies. This is our main launching point. So if we type in, and there's also an option for it to pre-populate for you. We type in fixed income, and this is where we'll start getting all of our data. You can see our sources on the side. Much of this is coming from the FRED database. If you want to check your API keys, if you have access, you can type in your keys command. The FRED database is free for access. You can go in and get your own API key, and you'll be able to access everything that I'm about to do and more in your terminal. We can show reference rates, so euro rates, American interbank rates, central bank rates. So this is the Fed projections. We'll be talking about all of these government bonds from across the globe and yield curves, corporate bonds. So this is from individual corporations from across, mainly based in the United States. That's where much of this data is coming from, as well as spreads, which we'll review later. So one thing that we can do is look at the European Central Bank. To highlight interest rates for the European Central Bank, noted by the ECB, we have an ECB command. This can show you a range of dates, and we'll focus on 2021, 2022, and beyond, where we saw a decrease going into COVID and then an increase more recently. So here you can see that we have our ECB command. And if you're curious and you see a command in one of our menus, there's a great way to look and explore it a little bit more. If I type in ECB here and then -H, what that is that is our help command. That will bring up a list of what this is, what the command is, and what all the options are, just in case you want to need a reminder. So if I've never typed in ECB before, I know that this is going to plot 3 interest rates the ECB sets every 6 weeks as part of its monetary policy. So you know you're going to get 3 lines on your chart. These are the main refinancing operations and the rates. You can have our start and end date, and this is the way you would type that in: year, month, and then date. And then also there are a couple different ways you can select just deposit if you want, just refinancing if you'd like, depending on what you want to look at. And of course, these at the bottom are always standard: export, sheet, and raw. And I can talk about those in a second, but we will be doing a little bit of data exporting, but that is mainly what you want to export. And raw data is if you just want to look at what the most recent data points are without having a chart as an output. So let's look at our ECB. And here's our chart. So here we can see our top rate, this orange line, is our lending. And then we have deposit in yellow and refinancing. Refinancing, you can see there's a gap in the data there starting at about 2007. This is when we had the global, the financial crisis, the Great Recession, 2007, 2008. That was our last peak. And rates steadily decreased as we exited that. And we went into eventually what was quantitative easing, a period of very, very low rates, into then COVID. And this huge spike at the end, that's where we are. And one part of our new 3.0 terminal is we can zoom into this chart if we want. We can explore it a little bit more. We can zoom in if we want to just look at this most recent data and see what's actually happening. There's always good options for zooming in and exploring your data in our charting features. So then what about Federal Reserve rates? We just looked at the European Central Bank, which runs rates for many different countries. And the Federal Reserve is for the United States. So this can also be looked at as the Fed, as commonly referred to. So that's what our command is going to do. We will now look at the Fed interest rates and the central banking decisions there. And as we may never run this command before, let's type in the H command. Now you'll see that there's more options for the Fed command compared to the ECB command. And that depends on the kind of data that we get. We can get the effective federal funds rate data. That's the core of what we're getting. But we can get monthly, daily, weekly, daily data, excluding the weekends, annual, and we can also look at different start and end dates. There's overnight rates, and you can also get quantiles that will give you the spread of that. Sometimes the rate will actually fluctuate, so you can see the average of what you're actually getting, or the first percentile or the 90th percentile. We can also show targets over time. These are a lot of different options that the Fed has at their disposal. And of course, our 3 main at the bottom: export, sheet name, and raw, for those that want to either export their data or just see the raw data points. So if we type in our Fed, this is since early 1950s. There's a lot of data in here. There's a ton we can look at, whether it's historical information, what was happening in 1980 versus the era of quantitative easing after the financial crisis, as well as what's happening in COVID. If you know your exact dates you want to go for, you can type those in using the S and the start and end point commands. But if you also just want to take a closer look at a certain date, you can also just zoom. If you only want to export something specific, let's say data from the start of 2020, you would simply just want to start in to Fed and start and the start of 2020. And then export, and you can choose a different version, kind of file that you want, CSV, Excel, whatever is most convenient for yourself. And you can also name that file. So we call this Fed rates 2020.csv. Oh, I'm not getting my okay. I don't know, I'll give a name right, but we can select for it says it's CSV if you want. So it saved my file in my OpenBB data exports. And we can also use this to overlay data if we want. Now, the Federal Reserve does one thing that's also very interesting, and they look at expectations. This is the long-term objective of the Federal Reserve. People will try to guess at what is going to happen. They will also be providing projections of what the Federal Reserve will do on the short term and in the long term. And we have both of these metrics in our Federal Reserve, our fixed income menu. So also, again, if you're scrolling down, you're doing lots of commands and you forget where you are, if you type in a question mark, you can go right back to seeing a whole list of options for what you can do. And we were going to look at projections. This is our projections right here. And let's use our helpful -H command to see what our options are. Okay, so we know this is the Federal Reserve's projection of the federal funds rate. This is our long run. So this is what the Federal Reserve is projected to do farther out. We can check out what that is. So we can see a couple different options, the high range. So this would be, what is the highest the Fed long-term projection would possibly be? The central tendency, the orange line. And there's a couple different points. Some people believe what the Federal Reserve their projections will be. They'll say, we predict 2 Federal Reserve rate hikes in the next 6 months. Some people will think that is absolutely true, and some people believe that is not true, and they're guiding the system and the economy in the way they want. There's a lot of speculation that can go into this. Many economists and investors have their own individual theories on what the guidance versus the projections versus what the Fed actually does. And I encourage you to look into it, formulate your own ideas. The Federal Reserve does have their own meeting minutes and they're all public. You can tune into those and you can actually make some investment strategies based on those if you would like and are interested. We have the core data here for you to look at and explore. Before we go into the economy menu, I'll stop and ask if there were any questions or anything specific people wanted to look at and see. Darren, I don't know if we got any questions specific on the last ones that I should show.
No, you showed the Fed fund rate command again, and that's the only question we have so far. So if anybody has questions, feel free to speak up.
Paul, I believe you.
Yeah, I have a question. Can you hear me?
Yes, we can hear you.
Oh, great. So when you just did the projections on the the Fed funds rate, was that off the futures or was that off the Fed fund releasing what they think it is? Like how did that get calculated? I was a little unclear because there's 2 ways to do it, right? There's the Fed funds what they project they're going to do, but then there's another way to do it off of the futures, which I think is more common, what people believe is going to happen.
It was the first one that is correct. This is what the Fed is
projecting themselves.
Projecting themselves, correct. These are not the futures. This is
yeah, I totally got you.
Yeah.
I got you. So do you have plans to kind of do more of a futures based where they say, if you kind of look at the traditional way it's presented would be like, for the next meeting, it's 70% chance, and then the meeting after that is like 20%, and then there's a 0% chance. That type of information, or that type of let's call it a program that would run and kind of display that.
I don't think we strictly have a plan for that exactly. Although one thing, especially with this menu with fixed income and the economy, is we're always looking for feature requests. We do have a place to suggest or request features that for users. So if you would like and you're curious and want us to take that into account, feel free to, and Darren can send it in the chat feature request page, and feel free to let us know. We're always looking, especially also if you have new data, we're always looking to add more data into our system as well.
Yeah,
I
sure,
don't
sure.
believe we have any strict plans on adding our own projections or models in. We tend to give you the tools to be able to make everything that you want to see and examine.
Right. And just to be clear, that would be a model that uses the futures to come up with a percentage of the next date that the Fed met, the percentage that the futures is projecting that they would raise. But if you just offline send me how to put in a request, I could even help you guys write it up to code it up, as long as it's in Python. But
Yeah.
I'll go ahead. That was my only question. Thanks. I'll lower my hand here.
All right. So now we'll take a look at the economy menu. This is where you'll see some other common indices and data points referenced. You can see them in the New York Times. Various people across different analysts and organizations will reference things like CPI. I'm sure many people have heard of what exactly that is. And we will sit out here. And again, we can always see where we're at and what our menu options are with our question mark command. And we can see economy, global macroeconomic data. That's where we will see this next set of information. There are a couple interesting things I will point out in this menu. The Big Mac index, we have a couple interesting things, an overview of indices and bonds. There are a couple of things you can get right off the bat. The economic calendar. So like we just mentioned, the Federal Reserve has regular meetings and release dates for their data. You can see what date those events are, all right here in the terminal. For country performance, we can look at GDP, things like that. But for this purpose, we'll be looking at CPI and components of CPI. And we can also look at other different US Treasury rates as well. So first, we can look at what will be the consumer price index of the European Union. The European Union, of course, is made up of many countries that breaks down into different countries. But overall, we can have that as a group in our terminal. And we can look at CPI in general or components of CPI. And there are a couple main areas. They're mainly broken down into food and other consumer goods and energy. Those are two main sectors that people look at. That's the two that I will focus on. And it is always good to know that when looking at inflation, a standard level of inflation or target rate is usually at around 2% for an individual country, whether it's the European Union, the UK, or the United States. That's usually what the target rate will be. 0% inflation is actually sort of a complicated economic concept that is not great. You want prices to slowly, steadily increase. And I encourage you to look at those and look into that research if you're interested in that topic further. But for now, here, let's actually look at CPI first. And we can, oops. Question mark. Just to see what we can do. So because we have so much data, we can look at individual countries. This is where you see that come up now in our different arguments we have for the CPI command. We can look at growth, frequency, monthly, quarterly, or annual, and a couple other different points, but we'll focus on just country, growth, and frequency, because you want to match up the data with what you have, and of course, export the same. So if you're looking at yearly data for population and trade, and you want to get CPI, you want to make sure you're gathering that yearly data instead of quarterly data. This is our US quarterly data, our default based on growth over the previous year. But we do have defaults for all of our menus. To get the European Union, but we can do the price breakdown for the European Union. Like we're showing here, CCPI is a different command. So instead of CPI, which is the overall, the entire basket, we can look at an individual breakdown. And we can look at a couple of these you'll recognize from the previous one. Countries, I mentioned earlier the different breakdowns of different baskets inside CPI, energy, food, etc. There's further breakdowns, but that data can get sparse and harder to handle. We can have frequency, different units, and of course, start and end dates and our export and raw data. And here we have our European Union overall data. This is the annual, that's the default. You can set it to whatever growth rate you would like. Of course, you can see the CPI in 2022, one of our highest levels. So let's see, what is that? 11.5% in September, October of last year. And that was a consistent increase that we saw over time. There was a lot of worries. There were a lot of things like conflict around Europe. COVID had a strong impact on supply chains. Prices were going up all over the place. And this is when you would see an action from the central bank come in to try to help tame those prices. And this is where you can go back and forth with the previous screen's data, the previous menus data in the fixed income section, and see how a country may have reacted in coordination or trying to battle this price increase that you can see that happened throughout Q4 of 2022. But let's talk about, switching topics a little bit, on the impact of government bonds and expectations. We will go back to our fixed income menu. And this is where we're going to start looking at the government bonds section. There are many different kinds of bonds that governments offer. There are short-term bonds, long-term bonds, and each of those serves a different purpose, and investors favor them for a range of options. But they do tend to move in tandem with one another. And we can show that in some charts as we'll look, whether between countries as well as different maturity levels within a specific country like the United States. So for example, we'll go to Treasury. And again, we use our help command here. This is where we can see short and long. So this is a 3-month rate or a 10-year rate. And the governments will adjust these, especially depending on inflation. When you hear about a change or a flip or an inversion of a yield curve, that's when these different maturity levels are changing and the yields on those bonds are going to change drastically. And that could be an indicator of a recession or exiting a recession. And again, a great topic of research if you're interested in this area of economics. And of course, you can have our start and end dates, as well as exporting whatever you might want to do in the raw data. So let's look at Treasury long for the United States. You can see overall, with the orange line being the United Kingdom and the yellow line being the United States, their 10-year rates do tend to move pretty closely together. There are some times when they'll change, and that might be called spread between countries, where this is 1974, when the United Kingdom was up at 16.3% yield, and the United States was down at 7%. Could be an interesting area for research if you're interested. But if we look over here at our more recent data, we can see the two countries moving much more closely together. does separate a bit before COVID, but as we then entered COVID in 2020, the rates almost move in tandem exactly with one another. The peaks and the troughs, their correlation would be quite high, although the United States consistently being a bit higher and now just peaking out below now. They tend to move very much in lockstep with one another overall. And if you go in and select different countries yourself, you might see that a different country, whether it's something in North America or in Europe, could have a very, very different struggle with how they monitor and offer their own bonds, and the yields can spread and vary very widely. And now this is also what I mentioned about the yield curve. So what we saw right there on the past screen was the change in yield over time from one different bond. But what if we look at all the different levels of maturity at one point in time? That will give us the yield curve. You can see in this chart on the screen right here, this is the US nominal yield curve as of this date. You can set what dates you would want, but we have a command in here for you that will give you this exact chart, but up to date. So let's take a look. Let's see. Okay, the US one may have broken, but we can show the ECB yield curve. So on the left, these are going to be your shortest term maturities, and going all the way to the right, your longest term maturities, 30 years, up at 3%. And you see our lowest is 5 years, and that's at 2.9%. And now this yield curve will vary widely, especially if you look at certain dates in the last maybe 3, 4 to 6 months ago. They will look almost completely different. There are people that take this as a sign of going into a recession, whether or not these points, the short term, are higher or lower than the long term. I guess for you, it's like this. That will be a good indicator that the economy, there's a shift in how valuable the time value of money is and how quickly people want to be paid back, or how much they believe they will be paid back given a longer time frame. Now, the spread would be the difference between those long and short-term interest rates. And instead of trying to do lines and calculate it yourself, there is a command for this. So we can actually look at the spread and the inverse yield curve. That's basically what can be thought of as the spread. And that's with our command TMC, which I'll show in a second. And that will be the difference between the 10-month and the 3-month government bonds, the yields on those two bonds. Change up our dates here, and let's make it a little easier to read. And oops. So you can see just with your plain eye, or actually we can draw a line if we'd like. There's a pretty steady increase in the lowest and the highest numbers for quite some time since 2020. But then 2022, that's midway through the year, end of Q2, there was a change, there was a shift. This spread in the difference between the 10-year and the 3-month government bonds completely changed. It actually went from over 2% to negative 2%. So that is a complete inversion in the yield curve. And that is what people are going to look at. Economists across the globe, the people at the Federal Reserve, when they see an inversion, they're going to look to try to take action, look at what's going to happen in the economy, what happens to corporate lending versus interbank lending, the ability for someone to get a mortgage. All of that can drastically change when you look at a shift in the yield curve like this. And I do encourage people to play with our new features, the drawing lines and everything on our charts. They're quite fun to do, especially if you're interested in, there's a whole segment of analysis that just looks at drawing fancy lines across charts to see what the peaks and the troughs are and try to time a perfect trade just in time to make that little bit of extra spread compared to anyone else who is waiting on official news, perhaps from the New York Times or the Wall Street Journal. So credit ratings, let's talk about those just for a second. Not everyone pays attention to credit ratings, but they are absolutely critical in determining what the interest rate is on a bond. Now, countries are all given interest or credit ratings, but so are companies. And their analytics agencies, credit rating agencies. Moody's is one of the most popular and largest in the world. That's one that we'll talk about. A lower rating, they are done with letters typically. Moody's does them with letters. So AAA all the way down to junk. It's actually isn't given a letter. It's just labeled as junk. But usually BBB is sort of where the line is drawn between something that's investment worthy or below investment quality bonds. And when you have a lower rated bond, you would expect the yield to be higher. They are less likely to pay someone back. So that means you want a higher return for taking the risk of not being paid back. And we have a whole section for this in our fixed income menu. This is the corporate bonds and spreads that we'll be looking through. And again, this is in the fixed income section. We can show a couple examples here of times when there have been huge differences across countries. We referenced this in our previous webinar, the Greek debt crisis. I encourage you to look at that. It's on our YouTube channel as well as in our presentations in our hub. You can watch the replay of that where Jeroen takes us through a more detailed analysis of what is happening in a chart like this, where you see Greece much, much higher as a country. They were defaulting or about to default. People were worried they could not pay their loans and their bonds. So the yields skyrocketed on those because people wanted a higher yield for the risk of not being paid back. And you can see Germany and the rest of the Euro area very much down at the bottom with those. Again, that video is much more in depth and is on our hub page as well as our YouTube channel. But let's look at corporate bonds. The main benchmark, or one of the central places that actually looks at the difference in these corporate bonds, is actually made by Bank of America. They have a corporate bond index and benchmark. It's called the ICE index for short. And this is a very well known, you can look it up and find all of their different metrics that they have. It's very popular. And it's a corporate index that focuses on the difference in quality between investment grade and non-investment grade and other various different levels you want to place it at, what the difference in those yields are. So it is similar to the spread that we saw earlier. What is the difference in two different bonds in terms of the yield? What is the spread on that in a certain sector or a certain country or between different companies? And a company is going to typically release bonds when they want to raise capital. This could be in a time where they want to do a significant investment. They're a healthy company, and they could be rated AAA, and they want to raise money to make a massive investment in research. Or if they're a real estate company, they want to make a big real estate investment and expand. Or a company could be more desperate. They could be in a state of financial crisis, needing deposits, needing money to survive. And that's where their ability to pay back is going to be much lower. And you're going to see a big difference in companies, different sectors and across the globe, where those lower bonds, whether they're junk or below BBB rated, will have much, much higher yields than those that are investment grade or the top quality bonds. And so high grade and high yield are two different ideas. And those are very important when you're looking at the ICE index. And we can show that on a chart in a second here. This is a difference between bonds that are below investment grade. So that is where the company is less likely to pay back that bond. They are a higher risk. And a high grade is a good bond that is going to actually have a lower yield. So the price or the return you're sacrificing is being more sure that you're going to get your money back. So let's take a look. Let's go back to our help command, and I will show you all the options. So there are a lot of options when it comes to the ICE index and what they are offering. You can look at different returns, total return and yield. Yield to worst isn't something that I'll go into, but there are all kinds of fancy concepts you can look at when you're looking at bond returns and yields. We can look at different categories: duration, European or Euro, US dollar. You won't find a lot in other countries. If you're looking for something that is specific to India, we may not have it in here. That data is harder to come by. But again, for anyone who's watching who does have sources for that data, we are always looking for a collaboration or feature requests if you know where we can start getting that data. We can look at different regions, so you can collect data on a larger region instead of just one country. We can look at specific grades. This is A all the way down to is triple C, and there's buckets. So high grade would be everything in triple A and above. And of course, our start dates, end dates, exports, and raw data are always. So the spread, as I mentioned, is going to be the difference in the different grades of bonds that are available. A little out there. Sorry about that. So our current here, our spread, which is going to be that difference between the investment grade and the non-investment grade corporate bonds in the United States, is going to be 1.39%, and that's the difference in yield. And you see these huge spikes throughout time in 2020. So that could be COVID related, as well as, of course, this will be the financial crisis in 2008, 2009. Banks are failing. The whole economy is in turmoil. Companies are struggling for cash. All sorts of different things are happening in that mix. And that's where you see that spread really widen. And it went up to 6.5%. That is a huge, huge spread. We haven't seen something like that in over a decade now. Hopefully we won't, because that is not a good sign. Now let's see if the there we go. Okay, awesome. So now this is the overall effective yield. So this is no longer the spread. This is just the main index of what the yields are for corporate investment grade bonds in the United States. The yields are going up. There's a lot of strange things happening in the economy. When yields go up, it usually means it's being more expensive to lend. Now it's more expensive for those corporations to get money, whether they're lending or borrowing from the government. And it's also going to be more expensive for them to issue bonds to go out into the public sector and try to get money from the public as well. Both of those rates are going to go up simultaneously. Oh, there we go. Good work. Okay, so this is single A US corporate effective yield. And if I wanted to, we could export this data set and we could actually visualize the difference between an A and a triple A. All right, let's go ahead and show this, because this is fun to do. So here, let's actually make this triple A, and we're going to export this data as a CSV. You can pick whatever format you want. It doesn't quite matter because we are going to then put this back into the terminal. So it's best to just keep it as a CSV. Save it on your hard drive as well. So now I looked at AAA in my export. So we can pick a different one. Let's pick BBB. So now these will be our BBB bonds. And we can overlay our chart. Pick my most recent. This is a default folder that is on your computer in your OpenBB downloads and exports. It will automatically put your file here. for you. So once you go in once, everything you export will be available in this folder for you. You have our y-axis, and we want them to share a y-axis, of course, so they are measured the same way. And let's make it. So instead of calculating the spread of AAA versus BBB bonds, we are visualizing it instead. The red line would be our AAA, and our yellow line is our BBB, the higher yield going towards the lower quality bonds. So just a different way of showing your data, and you can overlay as much as you want onto this. We could export 3 CCC and have those incorporated in here as well. I think we had a Paul here. Do you want to ask a question?
Yes. Can you hear me?
Yes, we can hear you.
Yeah. So you know how you just overlaid that? Can you do that with the YCRV, the yield curve? Can you do the exact same thing you just did with like different dates? So let's say
Yes.
you want to look at the yield curve. You can do that. You can do that with any chart. Is that what's going on? I guess I'm kind of guessing. Okay.
Yes. So let's look at.
Just do pre-COVID. I mean, it'd be very different.
Yeah. So, or yeah, let's do something that's let's
2018,
do like 2017. Yeah.
There you go.
And then we can export CSV. So this will give us the yield curve for the US on the January 1st of 2017.
That date may not exist.
Sorry. Maybe.
In our data set, there it might not exist.
I think it'll exist because
I don't know if
treasuries
they publish. I don't know if they publish a.
Oh, it might be a holiday.
January 1st.
Oh, yeah,
that's actually
yeah.
a good. That's a good
like
point.
The 3rd or the 5th or something like that.
Let's do that. Okay, that's a good call. Export. So then that will be saved in our folder, and we can name that something different if you really want to make it simple for yourself. And then we should just be able to type in our YCRV functions that will give us the most recent data. If you're looking for another specific date that you wanted to directly compare to, you could type that in here. But for this purpose, we will just get our regular yield curve. And here we can go to our overlay, choose our file.
Yeah, that's rate.
Yeah, so we want rate. It should work.
Do the yeah, that should be it, right?
It may not have data. May have picked a weekend.
No, I checked. It was Thursday. I don't know why it's not working, but I get the idea.
Yeah, but that is the overall process. If you wanted to overlay different kinds of data, you can do this with different stocks, basically anything, as long as you export it and then loop it back in, and you can decide whether or not you wanted to share that access as well.
Right. That's great. I have one other question.
Sure.
You know, because the topic was central banks, and one of the important things that people look at is the size of the central bank balance sheet. Is that something that OpenBB has on there? I don't know. I was kind of looking around for it. I could not find it.
So we would want the actual flow of funds and the full balance sheets.
Right, the full balance sheet of the Fed, like, you know, because right now they're selling. They have a program where they sell so many treasuries and they're taking their balance sheet down.
I believe that is WALCL. It's in the economy menu under the Fred.
Yeah, so
the Fred.
okay. So we would have to search in the thread parameters. So what's the
I believe it's
parameter?
WALCL. Yeah, there you go. Total
Yeah,
assets.
Yeah.
nice. There you go. Awesome. Thank you very much. That was good. Well done.
Absolutely. All right. Again, thank you everyone for joining our webinar today. Again, if there are more questions, please feel free to reach out to us. We have a great Discord community that Darren helps run. If you're trying to troubleshoot or just get involved and see what other people are working on. We have more events that are upcoming. We'll rerun our Getting Started for new users in Terminal. If you're just getting familiar with what we have and how to go through the terminal, how to connect your data, we'll be going through that, as well as an upcoming webinar on the software development kit, or the SDK as we call it. And that is for Python. If you want to get into the open source code and learn to make everything custom yourself, or even perhaps become a contributor to our open source project, that is the webinar for you. So you can go into the hub and you can sign up for our webinars there. It'll also be announced in our newsletter as well, that will go out at the end of the month, along with any other updates or news that we have with our company and project. So without our no other questions, we'll let this webinar end. And thank you again for everyone for coming. And I hope you have a great day or a great night for those that are over in Europe. Thank you so much.